Hello and welcome. We'll give everybody just a moment to get logged in and then we will get started. All right. Well, we will get started here. Thank you all for joining us. My name is Rob Elsholtz. I'm one of the principals here at REDW Wealth. I am joined by my colleague and our head of our financial planning, Christine Papillion. We are here today to pick up where we kind of left off on Tuesday around the Secure Act and retirement plans. This is going to focus more on the business side of things. A couple housekeeping items on the bottom of your screen, middle of the page. If you have questions, there's a Q&A button. We're going to try to answer as many questions as we can. If we're not able to get your question, we'll reach out to you after the webinar. So we'll go ahead and get started. We're going to go over a few things here. So we're going to go over contribution increases for the 2024 tax year. And then I'm going to jump into a few of the areas we're getting a lot of questions on around the Secure Act, and it's going to dive a little deeper. We touched upon them on Tuesday, our last webinar for individuals. If you have not looked at that webinar, it is available for on-demand use. So please watch it. But we're going to talk about emergency savings accounts inside of your retirement plans, employee matching for student loans, and then the fun one, long-term part-time employee eligibility, and then also to what to consider here going forward with your retirement plan. So getting started here, contributions. I did borrow this slide from Tuesday. Really enjoyed seeing this here. It is around the IRS limits. I know most of you missed it, like we all did too. The limits here for increasing a 401k contributions did increase by $500 up to $23,000. There's a great opportunity though that was put in here with a substantial increase around your defined benefit plan options. So I'm going to go into that as potentially as an opportunity to look into going forward. But there has been some increases across the board. We're still waiting here, patiently waiting for what our gifts exclusion is going to be, and then federal, state, and gift tax exemptions going through for next year. But as this happens, we'll have some updates around this. There was a COLA increase for Social Security as well. We thought about 3. It was a little over 3, so that's exciting. And then also here for your qualified charitable distributions, up 5,000. So these are some great planning opportunities that you can really take advantage of for saving for your retirement, as well as age-based catch-up contributions. As we can see here, it was pushed out for changing it to a Roth contribution from being just traditional. I'm very excited that it got pushed out. Candidly, I think a lot of plan sponsors are also excited that it got pushed out. So more to come. It may get pushed out again, but this is exciting news there that got pushed out opposed to only being Roth. All right, so we're going to jump into it. We're going to be very cognizant of your time. We're going to try to keep it within here over the next, looks like another 27 minutes here. I'm going to dive very deep into the 3 areas that I'm getting a lot of questions on around the Secure Act inside of 401k plans. First one's here is the Emergency Savings Act. So ESA, we're going to start with that, the acronyms. We do love acronyms in this industry. I apologize for using it, but if I have to say Emergency Savings accounts often, we'll be here for more than 27 minutes. So it is an optional provision. Sometimes you'll be referring it to or hear about it. You'll hear, oh, we're going to put a sidecar on your retirement plan. So it's a separate account that is really meant for participants in retirement accounts to be allowed to take a distribution to pay for emergency expenses. So what we see happen a lot of times inside of retirement plans is if somebody takes a loan and they end up paying back the loan if their plan allows that to happen. What this whole provision is about is to make sure that we're not paying those loans, because every time you take a loan, there is a fee. So there's some things here that make it's an optional portion that a plan sponsor can put in if they choose to do so. So it makes it where if a plan sponsor decides to do this, there won't be an additional fee charged for the up to the first 4 distributions. Everything that goes in is a Roth deferral. So there's going to be some things that would need to be done inside of the plan to set this up. It's self-certifying, meaning a participant would have to say that I self-certify the amount, and I'm self-certifying saying this is an emergency and it cannot exceed the need. Definition of an emergency is very subjective. I always say emergencies, we in my opinion, are pretty easy for us to say, like, hey, the radiator went out in the car, air conditioner, transmission, family, something's going on in the family I need to pay for, something that's of large expense. Somebody's birthday, not an emergency, it's on the calendar. So a holiday, that's not necessarily an emergency. Limits for contributions, they cannot exceed $2,500. And then for the plan, they may not require a minimum contribution amount or a minimum account balance, meaning someone can put, if this is adopted by a plan, if you want to adopt this in your plan, you can't tell your employees they have to put in a certain amount or they have to maintain a certain amount in it. It's only available, I should say, for non-highly compensated employees. So someone who's a highly compensated employee is not able to add this on to save additional amounts. And most of it must be invested in some sort of principal protected asset. So money market, cash account, potentially maybe even a stable value with no surrender charges. So it has to be something that's very liquid. It has to have security. So here's the considerations as a plan sponsor that you would need to consider. Must match, the same rate as a deferral. So if there's deferral rates on there, you have to put it on. It has to be the same as any other deferral rates that you would say to somebody. So if it's meaning whole dollar amounts, whole percentages, things of that nature. Contributions are included in your ADP testing. So this is something to consider if you're not a safe harbor non-elective plan, or you have testing problems. This may not be a great thing to put inside of your plan without making other adjustments. Once the balance reaches $2,500, you must stop contributions. So what this means is it's going to be a little bit more of a lift as you as a plan sponsor if you do put this on. And then you must develop a process to ensure that there won't be any additional contributions. So you'd want to work with your record keepers on there. So an additional notice requirement that's going to be coming through with this. The plan, you also may provide auto enrollment that does not exceed 3% into this. And there's going to be additional coordination between your payroll provider and your record keeper. So again, this is going to be a heavier additional administrative lift if you choose to put this in. Participant considerations, they're all Roth contributions. And then the contributions are also subject to that deferral limit of $2,500. As mentioned, there's going to be no fees. That can't be a fee subject for withdrawals on the first 4 afterwards, then a fee can apply. And upon termination, an employee can distribute this as they would as a regular distribution or a rollover into a Roth IRA. So what we're waiting for some guidance still, this is right around the corner when this could be added, is what type of rules you may need to implement to prevent participants from contributing over the contribution limit. And you just want to make sure that receiving employee match, what if you can do any employee matching, and then withdrawals of those contributions, what they're going to look like. Again, additional reporting requirements are going to be prescribed by the Department of Labor. So it's not a ton of guidance on that aspect as of this moment. It may come out this afternoon, some more guidance, or tomorrow or the day after. So more to come on this. But we've had a lot of plans that we work with and some companies asking those questions. So when we go through here, the next portion is going to be around employer match for the student loan payments. This feature is an optional feature as well. We've had different employers have asked about this and how this is going to work. And going through here, a participant would have to certify this every year. So this is going to be a lift not only on the employer, but also anybody who's a participant taking advantage of it. Your match rate as an employer is going to have to be the same as it would if they were doing deferrals, meaning if you have a 3% match, you'd have to do the 3% for student loans. Vesting's the same as this as well for those that matching dollar amounts. Matches on your student loan payments may be on a different frequency. So if you're a plan sponsor who does your deferrals every pay period, you can say, all right, I want to do this every quarter, but you can't do it less than annual. And then student loan payments is not considered an elective deferral. So this match is taken into account on your ACP testing. And then if you receive that, as you can mention, as you see here, if you're a participant who receives the match of a student loan payment, you may be tested separately. So when you're working with your TPA, it's something to consider here if you don't have a safe harbor non-elected plan, or if you have testing, if you're close in your testing along the way. So there's some limitations here. The amount of the loan payment considered for the match may not exceed the current elected deferral limit. So if somebody pays well over 30,000, 30,500 if you're over 50, or the 23,000 if you're under 50, and that match portion of it there, so it can't exceed that. And then the matching contributions for student loan payments may only be made to participants who are eligible to receive a match. So that is a very important part here. So if your plan doesn't have matching instantly, if you have a holding period, or you have to wait for this to happen, it does take time. And then it only applies for qualified education expenses while incurred as at least a half-time student. So there is some nuances to this that go above and beyond what the headline kind of talked about. Considerations here as a plan sponsor. This is going to be a big deal here. You're going to have to develop a process to establish any deadlines inside of here, and also how you're going to be safeguarding the participants' information. That's giving you this information about how they're paying and they're certifying. And you must establish how frequently you're going to do the match for the loan payments. So if you're doing matches for your salary deferrals, again, on a payroll period, and then you're going to do this, you're going to do these matches once a year or quarterly or monthly, you're going to have to come up with how that's going to be. So it's more complexity around how that match is going to be. This is a big part of the guidance here. We're still waiting to see if you do your match is calculated on a payroll basis, how you're going to make sure that the plan that participant made those payments during that time. They are self-certifying, but they'd have to certify that. So we're waiting to get some more guidance on that. Also, whether that match is limited to student loan debt incurred by that participant, not on behalf of their children. So if you have children that are, let's say, just turned, they're 17, 18 years old, going to college, and then their student loan debt that you're incurring for them, there's not really clear guidance if that counts towards this or not. So more to come. Again, this is something that we may get more guidance on this afternoon. So, all right, this is a fun one. I'm going to spend a few minutes here. The eligibility requirements for long-time part-time employees. So this started around the first Secure Act, and there were some service requirements here for 401k plans where 500 to just 999 hours of service in 3 consecutive years over 12-month periods. It's been reduced to 2 consecutive years. And this is going to be if your plan year certain periods are considered periods beginning on or after the 1/1 of 2021. Plan year begins in 2025 when the deferral requirements are met. So you have to look at this over several years, and it's anything that's pre-2021, your service is disregarded. So if you have employees that are just longtime part-time folks, you're gonna have to kind of put this into your calculation. You don't have to give them a match as a plan sponsor, but you have to offer it as an eligibility portion of it. So you want to work with your plan, with your record keepers around this, and your TPAs on the plan document, also your professionals on the advisor side. I can see there's going to be some issues going to be just right off the top of my head here of, well, one year they worked 475 hours, or they hit right at 501. So proper timekeeping is going to be very important with this. You're also going to want to make sure that it's very clearly communicated to those part-time employees that once they're eligible to participate in a plan. And then you have to make a financial decision. Should we give the match to these folks or should we not? The meaning of this is that we do, I see the importance of it, of why we want to have this is available. Is most folks can't have access to a 401k. They can't have access to a company sponsored retirement plan. This opens it up to those longer term part-time employees that are in quite a few different industries across the board. So there's some nuances that each plan will have to look at. If you have folks maybe that are seasonal that hit that 500 hours, those are things you want to talk to your TPA about, or a RISA attorney, or you want to talk to the advisor about what specifically is there. And then how you do your calculations and examples of those 500 hours each of the 2 consecutive years. You want to really be careful on this, because there could be some hiccups and things that could really tie things up on this. I anticipate there being a lot of questions around this once it actually goes into effect. I don't think a lot of folks at this point are paying overly too much attention to it, but this is something where we work with a lot of folks that have those longer term part-time employees. So really talking with your human resource staff or whoever's looking at those hourly employees and payroll provider, making sure it's accurately tracked is going to be very important for you regarding this provision. All right, so some things to consider moving forward. There's a lot of changing parts inside of the Secure Act that's going to change how retirement plans are administered, how they are looked at, and if there's going to be more requirements. The state of New Mexico and Colorado are actually combining to offer a Work and Save Act, where if you're a employer in the state, regardless of number of employees, there's a few restrictions on the type of employer, but it's pretty broad, that you have to either offer a workplace retirement plan or use one that's available on their marketplace. Sure, if anybody's went and looked at a marketplace for health insurance, there's some gimmies and gotchas there, and it isn't as robust as you would think it would be. So it is something that you'd want to look at if you don't currently offer a 401k or a corporate retirement plan, or something that you as a owner of a business is offering. You're going to have to offer something at some point, either required through the state or available out to you. So you want to take that into your own control. But if you have a plan, this is a really good time to meet with your plan advisor and also your third-party administrator to make sure that everything's lined up, and then making sure that the record-keeping platform that you're using is capable and able to help you keep your plan in compliance with all these changes that are happening. There's some changes coming along the way. I didn't go into it with slides. If your plan is audited, it's changing from having 100 employees to an actual 100 participants for an audit requirement. So there is a big change with that. So the good news is if you had 100 and let's say 15 or 120 or 130 employees, but let's say 50% were participating, your audit requirement is going to be going away. So that's definitely good news. It's going to save you some money. But if you are an audited plan, pooled employer plans, or a PEP, you may hear, is definitely an option. So if you're looking at your plan saying, okay, what can we do to make sure we're still staying compliant, but we're trying to maybe reduce administrative costs, you can always look into a PEP and talk with myself or your financial advisor you're currently working with about how those work. It could really help you out quite a bit on that extra burden that's there. And then cash balance plans. This comes back to earlier on when I talked about your contribution limits. This creates a great opportunity with these defined benefit plan limits, really being able to put a lot of money away. If you're a high cash flow business and you have highly compensated employees, being able to save a combined limit between this, potentially save between this and this number here, gives you a really large number that you could be putting away if you're a highly compensated business owner that has high cash flows. Being able to knock that big number right off the top before you have to go to the IRS, something maybe to look at doing. We're seeing the popularity increase again on these types of plans, especially I think we're going to see even more of it, especially when you see only an increase of $500 on this side of it. But it allows you to really save and put financial security for your future. They're not right for everybody. So again, you'd want to talk with your financial professional, and they want to work with an actuary that can look at your business directly and make sure that there's what's appropriate for you. I'm going to open it up here for some questions, and then Christine, if you have anything to add, we've got actually time. So,
which is a luxury.
Yes.
One of the things that we're seeing is that overall trend, right? We want to push people to save more, and now it seems like there's the guidance and the niceties around it. There's starter credits if you want to open up a plan or your 401k plan and even get, if you have fewer than 100 employees, 100% of those startup costs covered. Carry forwards for contribution amounts even for the next 3 years if you're contributing 5,000 to these employees. So you've got a lot of incentives. That piece is kind of a little bit of this nicety window where we're seeing regulatory actions possibly shift a little bit more to where policies change, and you see the mandatory side of things. Oh, well, we were nice. We gave you the opportunity, and we tried to push you towards the trend. Now we're going to force it. And you're already seeing that with some of the provisions on Capitol Hill now. We've got a provision where there is a thrift savings plan opportunity for low-income employees that don't work for the federal government or for the military. They're opening that TSP up they're proposing that you open it up for those lower dollar employees who don't have access to a plan, which that number is going to go down quite a bit if these long-time part-time employees get covered and become eligible and are now participants somewhere. But how many plans, if it's optional, are really going to adopt it right away? So I think you'll see a lot more. We had a very in-depth Secure Act 2.0 where we went through every single provision of the entire bill. And we do have that deck if you're wanting to see each of these things that are going to be implemented over the next few years. We wanted to give this more in snack bite sizes because when we went through that, I think all of us heads were a little bit, we had to take a break quite a bit through that one.
Yeah, this is definitely it's definitely at the forefront of what's going on out there, to your point of what's being talked about and proposed. The federal, we're recognizing as overall as a society, there's a retirement crisis out there. We're living longer. People have been saving less for a long period of time. And they've thought that Social Security is going to be there. That's my retirement plan. So having these availability options, especially for the long-time part-time employees, is very important that it's available. How many folks take advantage of it? Wait and see. But the big questions like we've had around those three areas, just wanted to provide some more clarity around those. And there's really hasn't been any other questions that have popped up. So I don't know, Christine, if you've seen anything on there, or
we had a few that we answered throughout, so that was kind of nice. And this deck is available along with the recording on demand. It will go out to you. There's a link to our landing page after that will have all of it. But feel free to email, ask questions outside of it. One of the things that you might start thinking is how to leverage if your plan does adopt some of these things and you do go on the forefront of it, using that as a talent acquisition. Advertising to these young professionals that still have student loan balances, guiding them to come to you because of that benefit. Even with some of the forgiveness programs that are out there and the IBR, pay as you earn, all of those programs that are out there now, and the forgiveness amounts being taxable, most people are still in windows where it's better for them to just pay the balance off as far as the total dollar amount going towards the loans. So you want to look at that, especially for the young professionals that are paying off grad loans. I think it's a very different story if you're your 10% of your income is zero when you go in. So it's certainly something to use to your advantage and update your plan ahead of time. We do have, I think, one question just came in here. The 2,500 saving contribution is on top of the 30,500. So Rob, in reference, you can go back up to that savings bucket, the sidecar piece of your account, that contribution portion. So it is in with it. It's not on top of. So you are utilizing that contribution dollar amount, but you're saying where it goes. So instead of saying it's just going to this tax deferred bucket that you can't touch and gets deferred, or you have to take a loan out to access it, instead it's going into this flux account where you do have access. This is ideally for those people that are in that cusp of trying to make the decision between having an emergency savings account and saving for retirement. So now those people don't have to make that decision. They can do this best of both worlds where if something happens, they can pull from it.
Great question. Great question.
It is.
Well, in that, we will give the greatest gift of time back for everybody. We really appreciate it. As Christine mentioned, we did a very in-depth recording of every provision a few months back, and then we've been breaking this down into bite-sized chunks. So our contact information is here on the screen. Please reach out to us with any questions, concerns regarding the Secure Act or anything around your retirement as well. We're here to help, and we thank you very much, and everybody have a great day.